One man stole $65 billion. He fooled Wall Street for 20 years. He wiped out charities, pensions, and Nobel laureates. He robbed Hollywood stars and Hall of Fame athletes. He ran it from a secret floor no one was allowed to enter. The government was warned 9 years early, and it did nothing. For nearly 2 decades, he was the most trusted man on Wall Street. A former chairman of the Nasdaq stock market. A philanthropist. A financial genius whose returns were so steady, so reliable, that the richest people in the world begged him to take their money. His name was Bernie Madoff, and to everyone who knew him, he was a legend. But behind the polished offices of his Manhattan firm, on a secret floor almost no one was allowed to visit, Bernie Madoff was running the largest fraud in the history of finance. There were no investments. There were no real trades. There was only new money coming in, used to pay off the old, in a machine that had to keep growing forever or die. When it finally collapsed in December of 2008, the paper value of the lie stood at $65 billion, wiping out charities, pensions, and the life savings of tens of thousands of ordinary people. And here is the part that should terrify you: one man had figured it all out nearly a decade earlier. He did the math, he wrote it all down, and he warned the government again and again. Nobody listened. This is the story of how the most respectable man in finance became its greatest monster, and how the truth was buried until it was far too late. To understand the fraud, you first have to understand how far Bernie Madoff had to fall. He did not start as a villain. In 1960, with a few $1,000s saved from working as a lifeguard, he founded Bernard L. Madoff Investment Securities. He was an outsider, a kid from Queens with no Wall Street pedigree, and he built his firm into a powerhouse by embracing something the old guard dismissed: computers. Madoff helped pioneer the electronic trading that would eventually become the Nasdaq, and he served as its chairman. His market-making business was real, legitimate, and hugely profitable. He advised regulators. He sat on committees. He was, by every appearance, a pillar of the financial establishment. And that reputation was the perfect disguise. Because alongside the legitimate business, Madoff quietly ran a private investment operation, and its results were unbelievable. Year after year, in good markets and bad, his clients earned smooth, steady returns with almost no losing months, ever. On Wall Street, that kind of consistency is impossible. Real markets rise and fall. But Madoff's line only went up, a perfect, gentle climb that never wavered. To his investors, it looked like pure genius. To a tiny handful of experts, it looked like something else entirely, a mathematical impossibility. But those experts were waved away, because who on earth could doubt Bernie Madoff? He was the chairman of the Nasdaq. He was untouchable. So how did the machine actually work? The concept was as old as greed itself. It is called a Ponzi scheme, named after Charles Ponzi, who pulled off a famous version a century ago. The idea is brutally simple. You promise investors high, steady returns. But you never actually invest their money. Instead, when old investors want to cash out, you pay them using the fresh cash deposited by new investors. As long as more money flows in than flows out, the illusion holds. To explain his impossible results, Madoff claimed to use a complex strategy called a split-strike conversion, buying stocks while hedging with options. It sounded sophisticated. It was completely fake. On the 17th floor of his Manhattan building, a small team generated fake account statements and fake trade confirmations, printed on old paper to look aged, showing trades that had never happened. Investors received beautiful monthly reports documenting profits that did not exist. And to reach the whole world without asking questions, Madoff used a network of feeder funds, investment firms that pooled billions from their own clients and handed it all to Bernie. Each feeder fund manager believed he was special, one of the chosen few. In reality, they were all just funnels, pouring other people's money into a machine that produced nothing but paper. What made Madoff so dangerous was not just the math. It was the trust. Bernie Madoff was a master of a technique investigators call affinity fraud, targeting people who shared his background and community. He moved through exclusive country clubs and charity boards, and word spread quietly that Bernie was letting a lucky few invest. He did not chase clients. He turned them away. And nothing makes people want it more than being told they cannot have it. Being a Madoff client became a status symbol, a sign that you had arrived. He attracted celebrities, Hollywood directors, Hall of Fame athletes, and some of the largest banks in the world. Universities trusted him with their endowments. Charities handed him their entire reserves. Even sophisticated financial institutions, who should have known better, poured in billions without ever demanding to see a real trade. Behind it all, a loyal deputy named Frank D. Pasquale ran the day-to-day machinery of the lie, manufacturing the fake numbers that kept everyone happy. For decades, the scheme fed on the one thing money cannot buy and fraud cannot survive without: absolute, unquestioning trust. Everyone assumed someone else had checked. Nobody had. And the man they trusted most was robbing them blind. But every dollar of those fake profits had a real victim. When the scheme finally fell apart, the human cost was staggering. More than 40,000 people, in over 100 countries, discovered that the fortunes they thought they had were simply gone. These were not all billionaires. They were retirees who had handed Madoff their entire life savings, trusting the safest name they knew. They were teachers and widows and small business owners who now had nothing. Charities that funded hospitals and scholarships were wiped out overnight and forced to close their doors forever. The foundation of Nobel laureate Elie Wiesel, a Holocaust survivor, lost nearly everything it had. And for some, the loss was too much to bear. René-Thierry Magan de la Villehuchet, a French aristocrat who had funneled well over $1 billion of his clients' money to Madoff, took his own life days after the collapse, unable to face those he had let down. Families were torn apart. Elderly people who had retired in comfort were forced back to work in their 70s and 80s. The real, direct losses added up to around $18 billion in cash that people had actually paid in, and would never see again. This was not a victimless white-collar crime. It was a bomb that detonated inside tens of thousands of lives. Here is what makes the Madoff story so infuriating. It did not have to happen. Because one man saw the whole thing coming, almost 10 years before it collapsed. His name was Harry Markopolos, a financial analyst in Boston. In the late 1990s, his own firm asked him to reverse engineer Madoff's strategy and replicate those magical returns. He could not do it. The numbers simply did not add up. Markopolos later said it took him about 5 minutes to realize the returns were mathematically impossible, and a few hours more to prove it. Madoff's performance, plotted on a chart, rose in an almost perfect straight line. As Markopolos put it, that line does not exist in finance. It only exists in geometry. He discovered that over the years, Madoff had reported gains in nearly every single month, a statistical impossibility, like a baseball player batting nearly 1,000 for decades. So Markopolos did the responsible thing. He took his evidence to the Securities and Exchange Commission, the agency meant to police Wall Street. He submitted detailed reports in 2000, again in 2005, and again in 2007. He practically handed them the fraud on a silver platter. And the regulators, the experts paid to catch exactly this, did nothing. The most important warning in financial history was filed away and forgotten. For years, Madoff's luck held. But a Ponzi scheme has one fatal weakness: it must always take in more than it pays out. And in 2008, the global financial crisis hit. As markets crashed, panicked investors rushed to pull their money out, requesting around $7 billion in withdrawals. Madoff did not have it. The cash simply was not there, because it had never really existed. The machine was out of fuel. In early December, a broken Bernie Madoff confessed the truth's two sons, Mark and Andrew, who worked at the legitimate side of the firm. Horrified, they immediately reported their own father to the authorities. On December 11, 2008, the FBI arrested Bernie Madoff in his apartment. The legend was over. He pleaded guilty to 11 federal felonies and showed little visible remorse. A judge sentenced him to 150 years in prison, a symbolic number meant to say he would never, ever walk free again. But the punishment did not stay on Bernie alone. The scandal destroyed his family. Exactly 2 years to the day after his father's arrest, his son Mark took his own life. His other son, Andrew, died of cancer a few years later, blaming the stress of the scandal. Bernie Madoff himself died behind bars in 2021, alone and disgraced. In the years since, a court-appointed trustee has fought to recover what was left, clawing back money from those who withdrew fake profits and tracing assets around the globe. Remarkably, the effort has returned the vast majority of the actual cash that victims lost, a rare and hard-won measure of justice in a story with so little of it. But no recovery fund can undo what really happened here. Bernie Madoff was not a shadowy criminal hiding in a back alley. He was the chairman of the Nasdaq. He was celebrated, decorated, and trusted by the most powerful people in the world. For decades, he sat at the very center of the financial system, and that system, with all its regulators and auditors and experts, failed to catch him, even when a whistleblower spelled it out in black and white. So the real lesson of Bernie Madoff is not really about one greedy man. It is about how easily trust can be weaponized, how reputation can blind us, and how the most dangerous frauds are not the ones that look suspicious, but the ones that look perfect. So let me leave you with a question. If the most respected man on Wall Street could hide the biggest fraud in history in plain sight for decades, how many others are still out there right now that we simply have not caught yet? Tell me what you think in the comments. Subscribe for another dark money story, and I will see you in the next one.